What if you were just one decision away from buying your first apartment building? Maybe your second or a third. What if you're just one decision away from financial freedom? Now, what I'm about to tell you is not a quick fix or get rich quick scheme. Okay. It's a mentorship program designed to guide you through your first apartment building deal and beyond to 1,000 units. Because you get to work directly with one of our highly experienced mentors who have already replaced their income with apartments. They're going to walk you through the entire process from where you are right now to owning your first deal and becoming financial free. We call it a deal maker blueprint. Our average student actually gets their first deal done in under 6 months. The average deal size is $4 million. Now, the reason for this is because of our deal maker blueprint, because of the mentors that you're going to get to work with, and because of the network that you're going to be connected in. Now, this isn't for everybody, but if you really want to change your life and you're willing to do the necessary work, then we'd love to work with you. Just click the link below to see if mentoring is right for you. Mark, welcome to the show today.
Thanks for having me, Michael.
Yeah, it's great to see you, man. I mean, you have built an amazing business with you and your, I think your dad and your family, right? It's a family business you guys have.
Yeah, we started that way, Michael. My father is officially retired. He still helps a lot with what we're doing, consulting, advising, guidance. He's been a real estate investor since the 1970s, and so learned a lot from him. But he's playing a lot of golf these days, Michael.
So he's actually let go a little bit and let you run the company. Is that true?
Pretty much, yeah. That's the way it's going. It's a good balance for both of us, so it's working well.
But was it like that in the beginning, or was it kind of tenuous a little bit?
It was definitely tough in the beginning, Michael. We got started formally. We formed our company in 2010, so through some tough times economically, right? And my father is a retired orthopedic surgeon by trade, but like I said, he's been a real estate investor since before I was born. But we started our company because we saw an opportunity to kind of expand on what we were doing as a family. Like prior to 2010, Michael, for about 5 years, myself, my brothers, my folks, cousins, aunts, uncles, we were all chipping in and buying real estate. I was handling all the operations with my father, and we built a nice little portfolio up and just wanted to keep going. So that's really how we got our start. And so at that time, it was, you look back today, you're like, gosh, we should have bought everything we could get our hands on. But back then, you didn't know. It was tough. It was hard to know what was going on.
Well, let's talk about that, because I feel like we're in a similar time potentially, right? Where people are like, oh no, let's not buy anything. That's a mistake, and then of course looking back and you're like, gosh, should have bought everything I should have bought everything I could put my hands on. But you guys got started really hot and heavy in 2005, which arguably was probably the height of the market. And so you went through 2008. How was that for you?
Yeah, I mean, we didn't sell anything. That was number one. We weren't forced to sell anything. I think we got a little lucky, Michael. Like some of the loans we took at the time had adjustable rate mortgages, but they had a nice situation where the rate actually went down. And so we got lucky. But we weren't forced to sell anything at the wrong time, which is how you lose money in real estate. We basically held everything. Gosh, we didn't start exiting until probably 2013, 2014. And then, at that point, we sold some of that stuff too early. And so we should have probably held on it for even longer. But, we learned a lot through that process. And we obviously went full time throughout that process versus part time by creating our company in 2010. So it is definitely an amazing time to go through, a stressful time. One of the things that helped me kind of guide us as a family and as a company was tons of networking, Michael. This is, the Pre-Jobs Act, right? So you couldn't go online and find a bunch of sponsors and operators and deals and all of that. And so you had to go in, at least what I did, I was going in person every week or every other week to some type of investor meetup club or group, shaking hands, listening to speakers. I did that for 2 years straight, and that's really how we learned.
How did that help, specifically networking? Get you through tough times, find deals, or how did that help?
All of the above. Yeah, it was. I wouldn't change a thing going back, looking at that period of time today for my career. It was imperative to meet the right people that had been through this before, in air quotes. It seems like every recession is a little different, but some of the same cycles and trends you tend to follow tend to reoccur. But you have a situation where if you're surrounded by people that have much more experience than you and have much more, I would say, insider information to the industry, to lenders, to other sponsors and operators, maybe they're operating a portfolio of 20,000 apartments across 10 different states. they're going to know more than you. It's just that simple. And so just be quiet and listen and ask a lot of questions. And so that was how I got my start, is just surrounding myself with folks it was a wealth of knowledge for me. Many notebooks full of notes, Michael, in person, right? So that's how I got it going. Yep.
Always learning, always learning. Now, I know a number of people who've lost their shirt in 2008 and 9, right? And it was obviously because they were over leveraged, underwater, foreclosures, blah, blah, blah. But there was also some where banks, called their notes due through various technicalities because of what was going on there. And so even very good operators were caught up kind of in the crosshairs there, in the crossfire. But how did you guys survive that? I mean, and you said you have variable rate mortgages right now, which is, of course, kicking our butts today because, well, shoot, 2 years ago was a pretty good idea. We all got rate caps. That's the way we protect ourselves. And now it's still kicking our butt. And so, now that same playbook isn't working so well, but it did in 2008. But what allowed you to kind of coast through that and hold your real estate versus having to sell or foreclosure or do stuff like that?
Yeah, I mean, at the time, Michael, we were very nimble, very much hands-on approach. That helped us then. And what I mean by that is, if you're doing it part-time and you have, again, I was single, I didn't have children, I didn't have a lot of other responsibilities other than my W-2 job. And so every day after work, I would go to our properties. I'd meet with our subcontractors. I was the property manager for several of them. And I worked very late, very hard, and busted my butt just to make sure that we were going to be okay. There was definitely a period of time, Michael, on a few of those assets in one or two markets. I'm just trying to remember exactly, but rents went down probably 20%. And that was the reality of it. And so what do? Do you hand back the keys? Say, oh, I quit? No, you've got to write a check. Some months we were negative cash flow. Okay, well, we're writing a check to pay all the bills this month, but we didn't sell. That was the key. And so it was tough. We worked our butts off, but we made it through it just by never quitting. And that's the ultimate mindset for me.
It really brings out, I think, the best in us and on entrepreneurs. Going through time like that makes us resourceful. And also, it does expose the bad players. I mean, it's interesting what happens when people go through tough times and or when large amounts of money are involved. It just reveals the true character of people. And I have a lot of respect for you guys going through that and surviving that. Now, since then, though, you've really expanded your business quite. Talk about what some of the stuff you've done, the different asset classes you've gotten into.
Sure. Yeah. I'll give you a little bit of background on how we got to where we are today. But obviously, you understand at the start, we were focused in the early years, Michael, predominantly on single family and small multifamily, heavier value add properties. We were buying a lot of stuff direct from bank, foreclosures, REOs, short sales, all cash, boarded up properties that you wouldn't want to walk in. And so we liked that because we could effectuate change to value manually and not worry about what the market was doing. And so we did that, very much our focus, all the way until 2016 or so. We were the sponsor and the operator on all of those deals and handled everything from choosing the paint color to managing the asset manager, the property manager, you name it, in the whole portfolio. But what I started to do when I left corporate America, I had a 401k sitting idle. You can't invest your own retirement money into your own deals. And so I learned that quickly and was a little frustrated about it, but those are the rules. And so I shifted those monies over to a self-directed IRA, Michael. And part of my networking process that I discussed, I met some savvy operators and sponsors in different asset classes outside of what we were specialists in: mobile home parks, self-storage, larger apartment communities, and started investing individually as an LP, myself, my family, to diversify. Right? I wanted to put my capital where I think it made sense and where we thought was resistant to the unknown of the market, the economy. And there was a lot of data back then and still today, but you could see some of these asset classes had fared pretty well through the recession. Mobile homes, for example, there's a chart by Equity Lifestyle, which is Sam Zell's company, former Sam Zell company, where they have this NOI growth chart, goes back to the early 90s, Michael. And every year it shows the net operating income growth on their mobile home park portfolio. Through recessions, it was still positive. And, that just always stuck with me. I said, gosh, what is it? What's going on here? And so this is pretty amazing. Let me learn more. And so nonetheless, we've been investing in mobile homes, for example, for the last 11 years now. So that was part of our shifting there. Today, we're a private equity company. We've evolved. We stopped doing single family, small multifamily as a sponsor operator, again, in about 2016. And we took some of those relationships that we had built, Michael, by investing with sponsors, and we started syndicating some of their deals. They negotiate better terms for our group. Again, a lot of it was relationship focused. Hey, we've been investing with these folks in this asset class for a couple of years. If you're interested in diversification, we have an opportunity. And a lot of our investor group came along. And so that's really where we focus today, is partnering with sponsors and operators in different asset classes and investing really with diversification in mind. We can reduce risk. You can reduce people risk, which is, to me, probably the number one risk, maybe equal to debt on an asset, but definitely up there. And we also do that in a way where we create funds, unique funds, where we'll combine multiple operators, multiple asset classes, locations, strategies, income, growth, and really just get a nice blended return. So again, with the goal of reducing risk while still earning a great return.
So have you stopped operating yourself?
Formally, yes, we have. We kind of made that call, maybe 5-6 years ago, Michael. We made that call and pivoted all of our attention to partnering with the right people and sourcing the right deals.
Talk really about some of these asset classes that you have invested in, and just very short synopsis of why you like that, and kind of more importantly, where it fits into the risk spectrum, right? You have super conservative stuff, maybe debt on the left, and then you have ground up development, all the way to the right, whatever. In your mind, kind of go through each of the asset classes and kind of talk about where it falls in that spectrum.
Sure. Yeah. As far as asset classes go, our bread and butter for a number of years now has been mobile home parks, self-storage, apartments, ATMs is another big one. We've been investing in these exclusively, but we started investing in some other asset classes in the last 2 years because of the change in the market conditions. That includes triple net industrial sale leasebacks, and also a fixed rate debt fund. And so it's a mouthful, but basically, coming back to your question, we like self-storage for a few reasons. I'll just go through them quickly, Michael, as to what are some of the pros and cons. But we find them to be fairly recession resistant, which is a big part of our thesis. You see demand increasing for self-storage during economic downturns, recessions. People tend to change something in their life. It can be a move physically, a job, it could be downsizing, moving in with roommate, and that usually increases the demand for storage. We saw that through 2008. And so that was one of the reasons we started investing in that asset class. Mobile home parks, very similar, but that's another segment of real estate, affordable housing. Mobile homes are typically the most affordable housing option out there. This is a long-term trend that we've been getting behind for a long time, where we think that the amount of supply is extremely constrained versus the amount of demand. And so, Econ 101, Michael, you've got tons of people who want it and not enough of it. Well, let's look at that, right? And so that was a big part of our investment strategy in pivoting personally in 2011 or so, when I first started investing in mobile homes. But you see that same trend today. I mean, it's probably even it's worse. Let's be honest. The lack of affordable housing in America is not going in the right direction. It's going in the wrong direction. There is a significant deficiency in every single state in the US. And there's a bunch of data I can share, but you can look and see the numbers of home ownership, for example, continue to go down. The number of people who are renting keeps going up. And so we like mobile homes because of a few of the cyclical reasons, where they tend to perform well during different economic cycles. But you also have a situation where they're very hard to build, if not almost impossible, a new mobile home park that is actually affordable in a desirable location. Most of those communities were built in the 60s and 70s, and today's zoning codes are just high barrier to entry to build a new one that is affordable. And so you have a unique asset class there, where you have limited or flat or even declining supply in some markets and a rising demand. We find that to be quite favorable. Then apartments, interestingly enough, Michael, we've been investing in apartments, for over 20 years, but I'd say the last year and a half, maybe almost 2 years, since the Fed started raising interest rates, our focus has been predominantly in tax exempt apartments where we don't have to pay property taxes. It's a niche within the apartment space that allows us to get a great return, cash flow day one, really favorable financing, and we're creating a win-win for the local community because we're keeping 50% of the units at the apartment building affordable by definition. So we're restricting the rents and the income that we allow people to have to be able to rent those units. And the other half of the units are kept at market rate. And so for doing that, we get a 99-year property tax exemption. So again, a lot of little niche stuff, Michael, that we like to invest in. We find, when going back to your question of risk and reward, that we are, I would say, probably a little bit lower risk, but we're trying to find the sweet spot, Michael. It's always the way it's been for me. Like, how can we reduce risk as much as possible without reducing our expected return? And so for expected returns, we're looking for, in year one, to give to our investors 3 to 7% cash flow. And we want that to be increasing through a business plan, a value add strategy. We want an average cash on cash, just while we're holding the asset, of 7 to 12%. And then when we add in the sale profits, we're looking for an average annual return on investment, or IRR, however you want to calculate it. That's usually 15% plus net to our investors. And so we find that those returns are achievable, but it's hard to find lower risk deals that can achieve those. And you mentioned it earlier, but development deals, like we don't really do any development, Michael. The last, I'd say, 4 or 5 years, every development deal I've looked at, not every, but most of them, I find that the risk is much higher and the return isn't much higher. Sometimes it's the same or even less than what we're getting. And so we're not interested in that. Why take on that extra risk if you're not going to get the extra return? And so let me pause and see what questions that brings for you.
So you built your business based on partnerships, and you mentioned networking as a key way to make it through not only the recession, but actually build your business. And you built that on strong partnerships. What is your process for vetting an operator? So you have different asset classes, and you're like, man, I got to find 1 or 2 really strong operators. You're looking for conservative deals. You're also looking for probably a certain amount of consistent deal flow from these operators so that you can grow your fund as well. But what is your process for vetting new partners?
Yeah, it's evolved over the years. As you can imagine, when you start out as a small LP, you're going off of a referral, predominantly from a friend or a colleague or someone that has already invested with them and has done well. And then I'm a financial analyst by trade, Michael. So I ask a lot of questions. I dig into the math. I like looking at Excel spreadsheets, but I also have owned and operated a portfolio of real estate across multiple states for many years. And so I understand the operation side as well. So those two kind of skills, I'd say, really help me look at how other people think and analyze and operate real estate. And so over the years, we've evolved. I'll say this: there's a lot of steps in the process for us, Michael, to get comfortable with a new group. It mostly today, if you're not referred to us, or if we don't have an investor saying, hey, these guys are awesome, I've been investing with them for many years, it's going to take a lot longer to get comfortable with just about anybody because they're new to us. And we have, over the years, Michael, vetted and underwritten, probably over 130 operators in different asset classes. And so we have a pretty good depth of knowledge of who's who. We don't know everybody, but there's a lot of people on that list that we work with and some that we don't and others that we won't. And so that process starts with, who are these people? How long have they been in business? What's their pedigree? Track record, experience is critical today. We're not typically working with groups that have less than 5 years of track record. We like to see exits, and we like to understand the story behind those exits. Were they able to grow net operating income manually by doing a lot of things, or were they the recipient of cap rate compression? Is that what got them a great return? And there's no wrong answer here. It's just trying to understand them a little bit better. Obviously, if they have some type of special sauce, what makes them unique, let's learn about that, right? And so we've got a couple operators that I think differentiate themselves from others. For example, one of them has a team of 6 full-time people. All they do all day long is cold call self-storage and mobile homeowners. And they've been doing that for 15 years. And so they have a Rolodex of mom and pop operators that they've established relationships with. So they get their deal flow usually not with a real estate agent involved, and usually off market, direct to seller. A lot of times that produces really attractive opportunities. And so we like that special sauce, right? That's just one example of the people and their operations and how they source deals. And so that's one aspect of it. And then we can get into underwriting as well. But I think pedigree is important. We look at references, background checks, both professional references and organic, I call it, where I go and try and find people that the operator doesn't know I'm talking to and ask them about them and try and get more of a candid response. And we also look, of course, very deeply at, when I said track record, a lot of times we'll look at the portfolio that they're currently operating. How's it doing? Show us, in detail what your initial projections were and how it's actually doing today. And are you above, below, at projections from a cash flow, from a net operating income growth standpoint? Do they have a cluster of properties in one market? That can be special sauce, right? They might maybe own thousands of units and operate thousands of units in one submarket. Well, they're going to know the rents. They're going to know the comps. They're going to know the demand. They're going to understand some of the nuances. Like, do we have to give concessions? Do we want to be west of Main Street or not? All of these little nuances make a huge difference. And so we're looking for something special versus just kind of a generic, hey, we're an operator in this asset class. We've been in business for X number of years, and we buy Class B value add workforce housing in the Sun Belt region. I mean, there's how many times I've heard that. It's like it's a very competitive space. So what makes you special and different? So I'll see if that's a good amount on the people. And if you want to talk about underwriting, I'm happy to as well.
Yeah, I'm actually curious about if you talk about a story where a partnership did not work out well. Right? We talk about a lot about our successes, and partnerships are really awesome when it's 1 + 1 = greater than 2. And then sometimes they can be awful. Like I'd love to hear just a little story about maybe a partnership without getting specific about that didn't work out.
Sure. Yeah, I've got one in mind. So this isn't a repeat operating partner we had personally invested with and raised capital with through our company in that order. And remember, we were looking at a new deal that they were giving us to potentially raise capital and invest with them. And they had a growth assumption that of rent growth, Michael, that was, it didn't jive with me. It stuck out too much. And this is in self-storage. So you can see pretty high rent growth assumptions because you can adjust rents within 30-day notice in self-storage. And you typically have, an average 10 by 10 unit is renting for about $120 a month, give or take. So to raise it 10%, the percent sounds high, but it's $12, right? And so not a lot of people are going to leave for $12. But they showed us this growth assumption. I said, listen, I want to take a look at your whole portfolio. What has been your rent growth historically? List out, annually per property. And it took me a while. They would not send it to me, Michael. Finally, they did, because I think the number was like over 12% that they were telling me they're going to be able to grow rents. And I was like, gosh, this seems high based on what we've seen. So they sent me the list. Here's the properties. Here's how much rent growth we've been able to achieve. And there was, 2 giant outliers. That one of them was a development deal. They just built it, and so they were showing it was like 65% rent growth. And the other one was like, I think it was like -3%. Where they actually had. So I removed the outliners, and what was the average? The average was 2 to 3%. So why are you showing me 12, right? And so that was a bit of a deal breaker to me. I felt like they were hiding the truth as to how much rent growth they've actually been able to achieve. And so we stopped investing with them at that point, and that was a good decision. And so that's one relationship that trust, transparency is just critical. And if people start doubting you, they start doubting your transparency or whatever you're sharing with them, and they think maybe that this isn't true, it sounds a little fishy, that's it. That's kind of a nail in the coffin for us.
Yeah, integrity is so important. And sometimes you got to pay attention to the little things, the little flags that you see, because if people kind of bend the rules a little bit in small things, they're going to bend the rules in a big way for much bigger things. So we've had similar experiences as well. But I wanted to ask you about your strategy to move away from operations to basically more of a private equity company. And we see this in multifamily syndications. We see a mix of operators and more private equity groups. People who move to private equity eventually become operators because, like, oh, I want control. I want more slice of the pie. I'm not getting enough equity just by being an investor for another operator. What was your pro and con analysis for saying, hey, because you probably talked about this with your family. We can continue becoming operators, and instead of doing little small houses, we can just do big, larger apartment buildings or get into self-storage ourselves. And you said, no, we're not going to do that. We're going to become a private equity company. What were some of the considerations to that decision?
And you're right, Mike. I've seen this. Different colleagues of mine go different routes. There is no one size fits all, right? You got to do what's best for your personality, your character, what you like to do, what your strengths are. I mean, all of those come into play, of course. So for us, I can speak specifically. First of all, our experience was heavily in single family and small multifamily, called 12 units or less, Michael. And we were focused on distressed assets. And so the supply of those properties was diminishing for years. We knew that. It was writing on the wall. And so we knew that at some point, these deeply discounted assets would no longer be deeply discounted. And so it was always in the back of my head, okay, well, what are we going to do? How are we going to pivot and when? Meanwhile, again, we had invested, myself and my family, in over 20 different other asset classes as LPs during that time period. And so we had data, we had trends that we could track and say, okay, well, look, these asset classes are actually doing really well as a passive limited partner. Why are we busting our butt to go and get 15% and knocking down all these doors in an asset class where we think that the margins are going to continue to get squeezed? It's also historically been more prone to valuation declines during recessions. And we thought there was a recession coming soon. Again, this is 2016, 17. And so we decided to put out a mobile home park deal to our investor network. Let's see what they think about this, from a repeat operating partner that we'd been personally investing with. And they loved it. They wanted to be diversified. They wanted to, be on the other side of recession resistance instead of being correlated. They wanted to be uncorrelated. And so that messaging was definitely absorbed quite well. And so that was a big part of it. It was a little bit of a test to see if can we even do this, because we wanted to. I personally, our motto has always been diversification since day one. And we create funds to help do that. And a lot of times when we were the operator, we would create funds of our own properties, or we'd put together, 4, 5, 6, 7 properties into one portfolio, so that if something didn't work in one of the assets exactly how we planned, the other one could possibly make up for it and help reduce risk. And so that's been a big part of it. But we decided at that point to shift gears, focus on diversification, focus on the relationships that we'd built with operators, and spread out our capital across different asset classes and people, of course.
So we're in a kind of a difficult time right now, and there's some people who are just sitting on the sidelines right now. And you're in different asset classes, obviously. Where do you see the opportunity, or are you one of those people who says, well, we're just putting on the brakes for everything, or where do you see opportunity coming up?
Yeah, it's a very top of mind topic for me, Michael. It's something I've been thinking about for years. I'll say this, we're still investing. We're still actively investing. We've slowed down because it's harder to find great deals, but they're out there. You just got to know how to make sure it's a great deal and where to look. And so I'll say this: in 2020, when the onset of the pandemic hit, we stopped investing entirely for 7 months into anything new on purpose, right? There could have been a catastrophic event, Michael, where asset values would have dropped immediately, very significantly. We were all told to stay at home and stop working. That's the quickest way to a Great Depression, in my view, that I can think of. And so that was an all pencils down kind of situation. And obviously a lot has transpired since then. And so that's not been the case. But where we sit today, I don't think is an all pencils down situation. And I'll say today, 2023, we're near the end of it. But for this entire year, we've still been able to find great deals that we think are worthwhile and should be invested into, where we can feel pretty darn confident that we can meet or beat the projected returns that are being shown, and sure as heck do better than a 5% yield in T-bill, which is great, very low risk, but there's just no growth. And so you're barely keeping up with inflation, depending on what you calculate it to be. And so we've continued to invest. We are very cautious. We're focusing on fixed rate debt, typically long-term debt. We're looking at lower loan to value leverage. We're looking at business plans where we think there is a clear path to growing net operating income in a meaningful, realistic way, not extremely aggressive. We're not going to double rents in 1 year, nothing crazy, Michael. It's just more based on current market trends, supply and demand, our operating partners' strengths, their ability to execute, what makes this deal special versus another. Why are we so confident we can do well here? And a lot of these deals that we find, they have stories to them, Michael. There's something about it that makes it special. And so to add some context, we've been looking at 10 to 20 deals a month. We invest in 5 to 7 a year. And so it's very much a filtration process. When we find something that we look at it, if it makes sense, okay, great, let's analyze the heck out of this and move down the diligence line and make sure that this is something that we actually want to send to our investors. And that process alone can take months. But a big hindrance today that most everyone's feeling is, of course, interest rates. You've got what are we, over 7% now borrowing cost, Michael, on most deals? And then the going in cap rate on a lot of these deals is lower, if not much lower. And so there's no free cash flow unless you very, very lowly leverage the asset. And so we're trying to find deals ideally where there's a nice margin between the interest rate and the going in cap rate. Usually it's 75 to 200 basis points, which is very healthy and doable, but hard to find, so that we can get positive cash flow year one, call it 3 to 7%. That's what we want. And a business plan where we can grow it. Now, we've also seen property prices go down already, probably 20 to 30%. And so if you're sitting on the sideline saying now's not a good time to invest, I get it. I totally get it. When is a good time then, right? And when it starts to go back up, we don't know what's going to happen and when. So trying to time the market is not anyone's game that we're talking to, Michael. If you run a podcast, have you found anybody that can time the market? Please let me know. Doesn't exist. And so you're going to lose money to inflation. You're going to lose your opportunity cost if you're just sitting around earning 5% with your money on a T-bill, for example. So we very much believe that unless there's a imminent danger or threat to valuations, that you should still be grinding and looking for great investment opportunities.
Yeah, that's awesome. Mark, it's been fun jamming with you. How can people connect with you?
Our company name, again, is SMK Capital Management. Our website is smkcap.com. We've got lots of information on there, Michael. People can join our investor group. You can email me directly if you have questions, you want to learn more about what we do. My email is info@smkcap.com.
Mark, it's been awesome. I really enjoyed chatting with you about all the different asset classes and the private equity approach. So thanks so much for being on the show today.
Thanks, Michael. Appreciate having me on.